Hey guys, for those that know me, know I've been a whistleblower regarding leveraged exchange traded products for the past 5.5 years. What originally tipped me off was that in 2018, I started trading these products for mathematically impossible profit. For those that know that I trade these products by betting against both sides, both pairs, both products in the product pair. SOXL versus SOXS, TQQQ versus SQQQ, boil, cold, et cetera, et cetera. Recently, my attorneys and I decided that we would go public with my information, as I believe this is a fraud that was structurally designed, mathematically designed to defraud investors, construed by Wall Street 15 years ago, where every dollar lost by investors was a dollar gained by the most nefarious participants on Wall Street. Recently, it appears that there's been some news coverage with Bloomberg and others about the ability to bet against these products due to their embedded decay. I believe this is a watershed moment, that it's only a matter of time now until it's a race to the bottom, betting against these products. And if everybody bets against them in a mathematical superior manner, we'll liken it to counting cards at a blackjack table. It's only a matter of time until these products collapse. I believe I'm probably the most educated in the world regarding the mathematics behind these products, at least publicly. And I'd like to reference some of the information that Bloomberg has reported, and then kind of help push these products so we can all bet against them in the most mathematically efficient way possible. Collapse them. And then once they collapse, just like with every other fraud, then people start looking at who was exposed, why were they exposed? And at the end of that rainbow, and what I've been a whistleblower on, is that these products aren't being held by, libertarian investors who are making their own investment decision. That the vast majority of these products are being held on behalf of investors that have no idea they have exposure. Asset managers, advisors are purchasing these on behalf of clients, letting them decay in accounts, managed money accounts, at the expense of investors. They're doing that because they're getting paid to do that. In fact, in the next video, I will show you proof positive that one of the largest defined contribution plans, ERISA plan, otherwise known as 401k, is holding hundreds of millions of these products at the detriment of investors. That'll be proof positive. And then you can use that publicly available information to check and see if your pension fund, if your 401k plan is holding these at your detriment as they decay. So I want to highlight Eric's post here. He mentions an individual by the name of Rob Arnott that came up with a new and creative way to bet against these products. For those that know me, know for the past 5 years, I've been very public about the methodology behind trading these products. Part of my whistleblower complaints to the SEC was trading as many of these products as I possibly could based on models I had previously given the SEC and seeing what the results would be. Over a 24-month period, 53.3% gross return, trading 60 of these leveraged products, 886 trades based off static models. So no guessing where the market was going, not dependent on the market. About a quarter of the beta of the market outperformed, like I said, and about 6% borrow costs. So about a 41% return over 2 years. During that same time period, the market returned 15%. So what I'm saying is these are mathematical impossibilities, but I've published my work. It can be validated. It's math-based, so there's not a question on if I'm right or if I'm wrong. If someone cares to take 30 minutes or so it'll take to validate, they will find out I'm right, and everyone can follow along. So I want to talk about this real quick, highlight a couple things here with Rob Arnott. So Rob says he found this new way to trade against these products. It's pretty straightforward. The performance of both types of these funds tend to erode over time thanks to the volatility drag associated with the daily option reset of these products. That's a misstatement there. These products do not hold options. They hold swaps, which means that the counterparty who is splitting the profit with Pro shares or with Granite shares or with Direction is a Wall Street counterparty providing the leverage component, the swap agreement. When these swaps don't pay out, when they don't need to pay out because the products decline over value, the money that's lost by investors is passed between the issuer of the products, the counterparties providing the swap exposure, and the advisors and affiliated parties that are receiving their payments of commissions or rebates or payments for distributing these products to unsuspecting investors. That's the fact. I will stay away from conjecture, from baseless accusations. All that it can be easily validated. So Rob says here, last year's gain was around 13%, of which half went to the borrowing cost for the short positions and 5% for the collateral, meaning he got that 5% back for borrowing the shares. And the return was about 12% with zero beta and zero correlation with just about anything. Arnott wrote in a follow-up email, not a brilliant strategy net of cost, but fun and low risk. So I want to, maybe compete here a little bit with Rob. A 12% return with zero beta is an amazing return. A 12% return with zero beta is the best risk-adjusted return you will ever find in your entire life. The question to Rob is, why would you not leverage this ability by betting against these products using options? So selling deep in the money calls, selling call spreads, buying put spreads. Leverage that up. You could leverage that up until your beta reaches 1 and have the same return risk profile as the market, but enhanced returns. This is what I do, which I've published and talked about. And now that it's a race to the bottom for these products, as time goes on, I will continue to push this envelope until the world accepts that I was right 5 years ago. And now we race and bet against these products collectively from an institutional level, from an individual level, until these products collapse and everyone starts asking questions. How did 200 billion of these products evaporate over the past 15 years? And who lost money at that? And was this a design scheme from the beginning? Those questions will be asked after it collapses, just like people who saw Bernie Madoff as a fraudster, which isn't just Harry Makopoulos, but it's several others. Before it collapsed, the argument was, oh, he's chairman of the NASDAQ. He's a great proponent for the Jewish community. And then you find out his victims were some of those that should not have been victimized by him. So, as I've stated for the past 5 years, all frauds collapse. It takes a few brave souls at the beginning to speak out. And I have the benefit that the fraud I'm claiming is all math-based, meaning that once people change the lens, change the way they're viewing things, the products will collapse on their own. Now we have Rob showcasing his ability to make money on it. I will enhance that for the public. I've already published my models, which were long before this article was written. The returns will be quadruple what Rob is inferencing here, and the world can decide, can validate on their own. So we'll go over that in just a moment. I've already released some of these things. Obviously, they're all published in a book I released last October. They were provided to the SEC over the past 5 years, and we can not only see what happened in the past, we can also use what I'm saying and judge in the future. If I'm right, these are math-based. Performance from yesterday will closely mirror the performance in the future. So once again, unless the game has changed, just like sitting at a blackjack table and counting cards, these products are on their last legs, and the collapse will be quick from here on out. And I will make sure of that, because I don't get paid unless I protect investors who have no idea that they're losing money. So questions here for Rob. Would love for him, would love to compete with what I'm releasing to you now, and going to emphasize, hopefully you look at and validate. Hopefully some others who have a larger voice than mine join in this effort. Would welcome anybody who's looking to help protect investors, is up to the challenge of doing some quick analysis to validate what I'm saying, what Rob is saying. And then let's move on to a second item here. So now we have the issuers of some of these products who are now also creating a double shorting the leveraged long product and a leveraged short product for that decay. This is product TQQ. This is going to be betting against this Defiance ETF, which goes live in June. It might not go live. We might collapse it before then. Bets against TQQQ. Excuse me. This is the wrong one here. Eric talked about. Let's see. Yes. So this is the TQQQ and SQQQ, and they also have a monster 2x long, 2x short. I've read the methodology behind this. I think some others have have as well. It appears to me that this product is only purpose. It will not perform as anyone is expecting as they reset on a daily basis. The product itself this product itself will decline in value. I will be betting against it in the most mathematically opportune way possible, and I'll provide that publicly for free as well. So let's in a lot of the work I've done in the past, I've kind of given the big picture, trading as many of these products as possible, creating a model that fits. It's not ideal for any one given product, but over the wide breadth of products performs at multiples of the market's return at a fraction of the beta. Some of that information, I'm going to skip to the website we've created here, has been given away for free. So in the man in the mirror model, which we provided to the SEC and have now provided publicly for free, everyone can access all of Bank of Montreal products based on that model, which is published in a book. I've also done a video on it, which essentially is shorting X value of the long product, 5X of the inverse product over a given quarter. Once the product drops by 10%, either side, you add to the short back up to the original starting value for the quarter. At the end of the quarter, you reset. It gives you a quarterly return. You can compound that over time. So under that simple model for all Bank of Montreal products, which came into inception first quarter of 2018 through quarter 4 of the end of last year, we can see that model crushes the market. And if that model was followed exactly as I just prescribed, absent borrow fees, it only has one down quarter of 3.59% when the S&P 500 went down 16.45. So a fraction of the beta, more than double the returns of the S&P 500. We have, maybe I'll shift the circuit for a moment. So this model can be used. There are other models I have published, but let's forget models. Let's go to the assumption that I'm right, that this was a digital snake oil financial product fraud from the beginning. It was designed that way. So what would that mean? Well, if we think logically, we can think of any business having to sell snake oil, digital snake oil, whatever you want to call it. The amount of money that they sell to the public, and if in this case, an ETF issuer they issue product to the public, so that would be issuance, and then they periodically buy back shares or have counterparties that redeem shares. So you have an amount of money that's collected from amount of money that's collected into Wall Street and their counterparties from issuing ETFs, and then when they redeem, that money would go back to investors. So if this was a design fraud, we can infer that the money collected from investors must be much more that goes out back to the clients in whatever mechanism you want to call. So instead of looking at everything in aggregate, like I've written about, proven, and then done previously, created a dashboard that anyone can follow along. We're just going to follow one of these products, but we're going to follow the most egregious product, the most profitable for Wall Street. It's product SQQQ, which like we said, Defiance is going to be supposedly betting against. So in that model, once again on their website, this is a $5 a month fee. We're looking at the SQQQ day late dollar richer model. I've already written about this. It's already in another video, so you can watch it, but it's very, very simple. We're going to follow along in proportion and bet against this product the same way Wall Street does. This information is provided publicly a day after the trading day is finished at night, which means the next day we can trade on the information we received from the night before. So hence the day late. So when ProShares issues SQQQ to the market, we're going to have the assumption that Wall Street is smarter than us. We're going to humble ourselves. They know what they're doing. This product wouldn't exist if it wasn't wildly profitable. So we're just going to take that one assumption. We're just going to follow what they're doing. So in this model, we don't have the same, capital that ProShares does. So we're going to scale this down to a reasonable portfolio. So the one I've published online, the one I do myself, is 1/100,000th of the total shares that are issued. So if they issue 100,000 shares tomorrow, I'm betting against one share. So when they issue, they're selling to the market, I'm selling short. When they have redemptions, I'm buying to cover. So this was released after the video, which was released 4 months after my book. But if we just followed the issuance, 1/100,000th, and bet against it the day after, just like I just posed, we would currently, from the 12th of March to present, we would have a total short of 441 shares. That'd be $14,000 currently short. Our profit just from March 7th to now would be $1,800, which represents a 12.3% profit off of the shares issued. This one product, if you had done that from the inception of this product to now, you would have over a 50% return per year just by following along. Now, once again, as I've written in the book, as I've shown the SEC, and as I've indicated in my previous video, we're looking at a 7-Eleven here. So this is the most profitable product. This is selling Zyn tobacco products, right? Huge margins, huge demand. Not every product is as profitable as this. So you'd have to look at the aggregate issuance. You'd have to look at SQQQ, TQQ, boil, cold, and all the other products that each issuer issues. But when you do that, it's not less damning, it's more damning. The amount of issuance that's sold to the market versus what it's redeemed at versus minus the amount that's currently outstanding, which we can think of as a liability, meaning that ProShares has to redeem those shares at the indicative value at the end of the day. That would be a liability, just like a debt liability. When we net all those together, we see tens of billions of dollars in profit with less tens of billions of dollars currently outstanding. And you can follow along. So from today until these products collapse, this is available, $5 a month. You can follow it yourself. You don't need to buy this. You can look at the net change in shares outstanding on a daily basis. You can bet against it if you want. My recommendation would be, hey, allocate 1% of your portfolio to this. It's mathematically flawed. I am right. No one can compete. No one can question that, especially if you do it in aggregate with all products. SQQQ has the worst mathematics. It's the quote unquote largest fraud that ProShares has at this moment. Previous products, VXX was one of them. The amount of issuance of that product, they accidentally overissued by $17 billion, $42 billion when they had permission from the SEC to issue $25 billion. Not bad for a product that's issued as debt and had an average decline of 70% per year. Once again, if you issue $100 of debt and it's worth 70% less in 1 year, let alone when that term is up, it's quite a profitable product. So if we change our paradigm and look at these the way I've said for the past 5 years, and now that Rob Arnett and Defiance is now admitting, Wall Street is now admitting, hey, there's a decay factor in these things that can be taken advantage of. I'll just show you how to do it better than everyone else. An interesting thought here is Rob Arnett also says, and this is the actual Bloomberg article, I hope they don't get upset that I'm giving this away for free, but he says other quants are also playing this trade, but there's a dearth of leverage ETF supply available for lending, keeping borrowing costs elevated. Don't worry, SQQQ does not have borrowing costs right now. Neither does TQQQ, neither do the majority of these products. And once again, as I'm helping Rob and you and all these other quants out there, you can bet against these products, the ETFs at least, with options. And if you do it correctly, the math stays the same, the leverage goes up, and everyone wins by betting against these products. So once again, in the book, man in the mirror model, short X value of the long leg, 1.25X of the short leg, continue to do that. If you did that for TQQQ and SQQQ, when did I start this one? Also on the 7th. Once again, after the last video was made a video called The Man in the Mirror. Watch it. The model's in the book. This is what Defiance should do. Defiance, copy me. Do exactly what I'm doing. Your investors in this ETF will be much happier. It will be mathematically solid in a very, not the most ideal model. I could share those later, but this is a model that pays off over time. Once again, card counting analogy. Every quarter, we're playing a hand of cards at the blackjack table. We're not guaranteed to win every single hand we play, but we're guaranteed mathematically to win more hands than we lose and to win larger hands than we lose over time because of the structure of these products, which if you care about any of that stuff, which most of you probably don't, it's in the book. Some of what I'm stating now is incomplete, it's because it's in the book. Buy the book. It's $10. I don't need your money. Use it to validate it. If you want your money back, no problem. I'm here to protect investors and balance out the structured products that Wall Street has created to take advantage as I said, not of people who know that they're in the casino gambling, but to protect those who gave money to a trusted fiduciary who is then gambling in a casino because they're getting some type of indirect compensation or kickback from distributing these products. Next video, I'm going to show you proof positive. Like I said, one of the largest defined contribution plans in the US, holding hundreds of millions of these products over a long period of time. Not just that they did it for 5 minutes and lost millions of dollars, but that exposure is there today as well. And then we'll infer where else these products should be hiding, because it's illogical that $250 billion of these products and other structured products are being held by retail investors. Retail investors do not, in aggregate, don't have that much money, period, let alone that much allocated towards these specific ways to gamble. They like to gamble in options, and they like to gamble in other things. We'll continue down that road. So once again, follow the issuance of SQQQ from here for forever. You don't have to trade it, but you can certainly watch it. We have a dashboard for you to do that. That's accurate, or if you want to back test or look in the future, it will be right. The mathematics will deem that it's right. And then logic also dictates that if you can sell something for X value, it's worth less than X at a future time period. Wall Street is certainly incentivized to be able to get that out to investors. And they can't do that if everyone's deciding whether they want to buy it or not. They have to do it through channels and distribution channels where those that are exposed have no idea they hold it. Once again, I'll show that proof positive next time. But for now, let's just focus on the math. So the man in the mirror model. So in the book reference, I give an example. I wanted to give a dollar value that everyone can kind of follow along. So it's $800 for the X value and $1,000, 1.25X when we're betting against the long. Once again, the criteria I've shown you, it's in videos, and you can purchase the book. So on 4/7/25, this is a real trading, just scaled it down, and then once again, put it on a dashboard so I don't need to share my portfolio with you. You can just see it through a model dashboard here. So 725, I shorted $1,000 of TQQQ. I shorted as close to $800 as I could of SQQQ. For every drop underneath that value, I shorted additional shares. So for TQQQ, that only happened the next day twice. Shorted an additional share. So we have a total of 22 shares short. We have a 47.58% loss on that. The unrealized loss is 42.85, $422.85. However, we have the other side against us, where we're taking advantage of the flaw of the mathematics of these products. Shorted 20, shorted 3, shorted 1, shorted 1, shorted 4. Next page, shorted 2, shorted 2, shorted 2, shorted 2. We have a total net cost basis of $1,600, even though we only started with $1,000 because the product went down and we shorted more. We have a 35% gain and a $568 gain. We have a total P&L $45. That's 6.16% with a very, very low beta. I'm not going to do the calculation. I didn't do the calculation before talking to you. The market is up huge in that time. And as we go on, remember, we're resetting this every quarter. There are products that are much more profitable than this one, following the same methodology. I'm proving to you that I'm right. I'll prove once we accept that this model works, that it beats the market, that it does so at a lower beta over time, then I'll start showing you the more advanced models on how, we get a beta closer to what Rob says. He's getting a beta of 0. Best beta I have is 1/8 of market beta, so 0.125, while beating the market by generating close to 40% returns annually. Once again, happy to share that with everybody for free. It's a race to the bottom, protecting investors while we do it. I'm gonna head out, but if you're interested, $5 to follow along the day late, dollar richer. We'll build a portfolio together later. We'll see you later. Cheers.